There's a moment every founder dreams of. It's the email notification from a top-tier VC. The subject line is simple: term sheet. You open the PDF and your heart is pounding. You feel like you've made it. But let me tell you, I've personally seen that exact moment of triumph turn into an absolute nightmare 6 months down the line because of one badly negotiated clause. Welcome to episode 11 of Token Launch Masterclass. Today, we're cutting through the noise and talking about negotiating term sheets, crypto-specific clauses you can't ignore. Look, understanding traditional VC terms is table stakes, but this isn't just about equity anymore. We're in Web 3. The complexity introduced by tokens, governance, and forks adds a layer of traps that can either secure your project's future or sign its death warrant before you've even launched. Okay, so before we dive deep into the crypto specifics, let's first orient ourselves. In the traditional VC world, a term sheet is all about equity. You're looking at the company's valuation, who gets paid first if things go south. That's liquidation preference. It's a well-trodden path, focused entirely on owning a piece of the company. Now, let's contrast that. In Web 3, what I see come across my desk are instruments like SAFTs, or simple agreements for future tokens, and token warrants. These aren't about stock certificates. They're about the right to receive tokens when your network eventually launches. And this is the mindset shift I find is crucial for founders to make. You're moving from selling ownership in a corporation to allocating ownership in a decentralized network. It's a completely different paradigm, and thinking in terms of network ownership is the foundation for everything we're about to discuss. All right, let's walk through the actual machinery of these deals. You're mainly going to encounter two instruments, the SAFT and the SAFE with a token warrant. Think of a SAFT, a simple agreement for future tokens, as a pure crypto-native deal. An investor provides capital now, and you promise them a certain number of tokens when your network launches. It's clean and focused on the network itself. A SAFE with a token warrant is more of a hybrid. The primary deal is for future equity, but the warrant gives them an additional right to buy tokens. What I always stress to founders is the need for absolute clarity on the trigger event. This is the specific milestone that turns that paper agreement into actual tokens in their wallet. Is it the mainnet launch? The first public sale? What I like to see is this defined with zero ambiguity, because that's where future conflicts are born. Now, let's tackle one of the biggest mental shifts: valuation. In our journey, we have to leave behind the language of pre-money and post-money from the traditional world. In Web 3, the term you'll live and breathe is Fully Diluted Network Valuation, or FDNV. Here's how I like to break it down simply. Take the total possible token supply that will ever exist and multiply it by the price per token you're setting in this round. That's your FDNV. It's a more honest measure because it accounts for the entire network, not just a company's slice. When an investor talks about a valuation cap or a discount on their SAFT, this is the number they're applying it to. What I find is that grounding everything in FDNV from day one prevents so much confusion and aligns everyone on the true, long-term scope of the project. So, once you've settled on valuation, our journey takes us to what I consider the heart of incentive alignment: lockup periods and vesting schedules. These two mechanisms are your best defense against short-term thinking. A lockup is simple. It's a period, say 6 months to a year post-launch, where early stakeholders can't sell. This prevents that initial dump that can kill a project's momentum. Vesting, on the other hand, is about earning your allocation over time. What I typically see work best for founders and the core team is a 1-year cliff, meaning you get no tokens for the first year, followed by a 3 or 4 year linear release. This structure sends a powerful message. It tells your community and future investors that everyone, from the founders to the earliest VCs, is committed to building long-term value. It's not just a clause, it's a public promise that protects your token's stability. Okay, so our journey now takes us beyond the economics into the realm of power and protocol. Holding tokens is one thing, but what I'm seeing more and more are clauses that grant VCs specific rights to influence the network itself. This could be early access to run staking nodes, or something more direct, like a guaranteed seat on a future DAO's governance council. I've even seen VCs negotiate for veto rights over certain protocol changes. And here's the delicate balance you'll need to strike. Leveraging an investor's expertise can be a massive advantage, but you have to weigh that against the risk of centralization. What I advise founders is to be wary of giving away permanent control. Your goal is to build a decentralized network, not a VC-run committee. All right, let's keep moving on our path. Our next stop is information rights, and this is where the Web3 world really flips the script. In the old model, investors got a quarterly report and maybe a seat at a board meeting. It was formal, and often quite guarded. What I find works so much better in this space is a shift towards real-time, transparent collaboration. You might find VCs asking for access to your private GitHub repos to see the code evolve, or a dedicated Discord channel with the core team for direct dialogue. What I like to see is founders leaning into this. You can even offer custom on-chain analytics dashboards. This radical transparency of the blockchain changes the dynamic completely. It's less about reporting up to your investors and more about building alongside your partners who can see the progress, or lack thereof, almost as it happens. Our path now leads us into some truly uncharted territory, something you just don't encounter in the traditional world. Network forks. A contentious hard fork can literally split your project in two. What I always look for is a clause that preemptively answers the question: if the chain splits, which one do my investors' tokens live on? What I like to see is the term sheet designating the protocol maintained by the core development team as the canonical chain. It removes all ambiguity. On a related note, let's talk about airdrops. What I find is that savvy investors will want to know if their investment entitles them to future tokens dropped by your project, or even by other protocols within your ecosystem. Defining these rights up front is just smart housekeeping. It prevents future disputes and shows you're thinking ahead about every possible scenario. All right, our path now leads into what can feel like a dense maze, the section on regulatory and compliance covenants. Honestly, this isn't the exciting part, but it's where a project can be saved or sunk. What I always check for first are the investor representations. This is the clause where the investor confirms in writing their status, that they're accredited, and often that they aren't a U.S. person. It's a critical first line of defense. Then you have the promises you make in return, the project covenants. What I like to see is a clear, good faith commitment to pursue decentralization and operate in a way that avoids securities law violations. But the real test? What I find truly separates the amateurs from the pros is a clause that outlines what happens if a regulator, like the SEC, later deems your token a security. Having a clear procedure for that possibility shows you're not just hoping for the best, you're prepared for the worst. Okay, as we near the end of our path, let's talk about two clauses that are really about rewarding your earliest backers. What I like to see is a most favored nation clause, or MFN. It's a powerful sign of good faith. It simply promises that if another investor comes in later in the same round and gets a better deal, say a lower valuation cap, your first investors automatically get those same improved terms. It protects your first believers. Then there's pro rata rights. Think of this as giving your investors a ticket to continue the journey. It grants them the right to invest in future funding rounds, to maintain their percentage ownership of the entire network. VCs seek these out because it ensures they aren't diluted into obscurity if your project really takes off. For you, it's about securing long-term partners. Okay, we've walked the path through the key clauses, but a term sheet isn't just a document to sign. It's a negotiation. This is where we talk about recognizing traps and building your power. What I always scan for are the red flags. For instance, if I see founder token vesting that's shorter than the investor vesting, that's an immediate cause for concern. It just doesn't signal long-term alignment. Another thing to watch for, especially with hybrid deals, are overly aggressive liquidation preferences on an equity side letter. And perhaps the most common trap is simply ambiguity around token delivery milestones. What I like to see is that tied to a concrete event. So how do you build the leverage to push back on these things? Well, what I find is that nothing works better than a competitive funding round. But even without that, a functional MVP or a deeply engaged community can be your greatest asset. Showing, not just telling, gives you the power to define your own terms. So, we've reached the end of this part of our journey through the Web3 term sheet. What I find helps is to quickly recap the key landmarks we passed. Remember to ground your valuation in the Fully Diluted Network Valuation, or FDNV. We saw how lockups investing are your best tools for signaling long-term commitment, and we navigated the tricky terrain of governance rights and those critical regulatory covenants. What I always stress to founders is that this journey should not be taken alone. What I like to see is a founder bringing in experienced crypto legal counsel early. It's simply non-negotiable. Now that you're prepared to negotiate, how do you secure that first meeting? Join me next time for episode 12, Pitching Web3 Native, How to Speak the Language of Crypto VCs, where we'll break down how to craft a pitch that resonates with the unique mindset of Web3 investors. If you find this information useful, we would really appreciate it if you would like and subscribe this channel to help others find us. If there are subjects you would like covered, please add in the comments section, and we will include it in future episodes.